Imagine a clock that doesn't just tick, it prints money. Each second you live, wealth quietly flows. But not to you. It flows to someone else, someone you'll never meet. The more time passes, the bigger the gap becomes. What if I told you there is a system of financial blueprint designed to turn time itself into payments, to extract wealth from patience, to reward those who understand the hidden rhythm of money? And what if this system has been quietly shaping economies, fortunes, and failures for centuries, leaving most people trapped in cycles they never even knew existed? Today we're going to uncover exactly how this system works, who built it, how it nearly broke the world, and why it still runs, silently, beneath everything you know about money. By the end of this video, you'll see that time itself is money, but only for those who hold the blueprint, and for the rest, well, they're paying. Setting the stage, origins of the blueprint. To understand this blueprint, we need to go back almost 3,000 years to the cradle of civilization. In ancient Mesopotamia, the first recorded loans were made, not with paper money, not even with coins, but with silver and grain. Farmers borrowed seed to plant crops. Merchants borrowed silver to trade. But there was a catch. They had to pay back more than they borrowed. Interest. Not a modern invention. Not a loophole. Interest was embedded into the very DNA of early economies. Why? Because rulers and lenders quickly realized that time itself could generate wealth. A year isn't just 12 months, it's 12 opportunities to earn more on what you already have. Fast forward to the Middle Ages, Italian banking families like the Medici refined the concept. They didn't just lend money, they lent time. Bills of exchange allowed merchants to borrow today, pay tomorrow, and the Medici collected interest in between. Suddenly, wealth was no longer tied to labor or production. It was tied to patience, to time itself. But here's the twist. While interest could grow wealth, it also sowed a hidden seed of instability. As debts compounded, they could spiral beyond anyone's ability to repay. The rise, compounding, in the modern system now. Let's move forward to the 17th century, when a seemingly innocent invention changed everything. Fractional reserve banking. Banks discovered that they didn't need to hold all deposits in reserve. They could lend out most of the money they received and collect interest on it. In other words, banks could create money from thin air, and time was their ally. Here's how the blueprint worked. Deposit. Someone puts money in the bank. Lend. The bank lends 90% of that deposit to borrowers. Interest. Borrowers pay interest over time. Repeat. The bank repeats this cycle endlessly. The result: a system that literally turns seconds, days, months, and years into profit. The longer the debt exists, the more interest accumulates and the richer the creditor becomes. By the 20th century, central banks institutionalized this process on a global scale. Countries borrowed from each other, from private banks, and from the International Monetary Fund. Every loan, every bond. Every government debt instrument followed the same blueprint: turn time into interest payments. And here's where the hidden twist appears. While this system rewards those who control it, it traps everyone else in a cycle where debt grows faster than income. The breaking point: when the blueprint collapses, this blueprint works. Until it doesn't, take the 2008 financial crisis as an example. Banks had packaged debts, sold them as securities, and collected interest at every step. The system was so intricate that no one fully understood the risk. Interest on top of interest, compounded over decades, became a ticking time bomb. When homeowners defaulted, the domino effect spread worldwide. Countries bailed out banks, not people. Why? Because the blueprint is designed to protect the system that turns time into interest, not the individuals paying it, but history repeats. The same pattern happened during the South Sea Bubble in 1720, the Mississippi Company scheme in France, and even the Greek debt crisis in 2009. Time plus interest equals exponential risk. And when it fails, everyone except the blueprint's architects pays the price. Fallout: who pays and who profits the fallout of these financial collapses is always uneven. Ordinary citizens lose homes, pensions, and savings. Meanwhile, institutions that understand and exploit the blueprint often emerge stronger. Consider quantitative easing after 2008. Central banks pumped trillions into the financial system. Stocks rebounded, housing markets recovered, but wages stagnated and personal debt soared. The blueprint had survived another test, intact. Here, said the shocking truth. The same system that created the crisis also ensured its recovery favored those at the top. Time continued to compound their wealth, while ordinary people paid the interest on loans they couldn't avoid. Failed fixes? Why nothing really changes governments and regulators have tried to fix? The system, caps on interest rates, debt forgiveness programs, stricter banking regulations, yet every attempt faces the same problem. The blueprint adapts. Interest simply finds a new route: credit cards, payday loans, student loans, sovereign debt. Time is still being transformed into payments, and the cycle continues. The core lesson: the system isn't broken, it's doing exactly what it was designed to do. Modern parallels the blueprint in 2026 today. This blueprint is everywhere. Consider student loans in the U.S. Over $1.8 trillion in debt, growing interest every day. National debt. Countries like Japan and the U.S. spend more on interest than on infrastructure or healthcare. Cryptocurrency lending platforms, even digital finance, is mirroring the same principles of compounding interest over time. Data shows a repeating pattern. Those who understand and control the system profit exponentially, while those who don't see their wealth eroded slowly, invisibly, by interest payments. Time is the silent weapon, the invisible engine of inequality. Takeaways: what this blueprint teaches us. Time is money, but only for those who understand the system. The longer money sits in the wrong hands, the more it compounds in ways most people never notice. Debt is a tool of power. Interest turns patience into profit, and those who control credit control the flow of wealth. Awareness is your first defense. Understanding how time becomes interest can help you make financial decisions that protect you from the system's hidden extraction. Warning: open-ended thought. The financial blueprint isn't going away. New technologies, AI-driven lending, and globalized debt markets will only make time an even more powerful weapon. The question isn't if it will affect you, it's when. Will you be someone who lets time pay someone else, or will you learn to make it work for you? Call to action: if you found this story eye-opening, make sure to like, subscribe, and hit the bell. Share this video with anyone who thinks time should just pass. They might not realize they are repaying interest on it every single day. And remember, the blueprint exists, but understanding it is the first step to breaking its spell.